Well, my next guest and her team just published their global outlook for 2026. I want to bring in now BlackRock Global Chief Investment Strategist Wei Li. And Wei, you know, your focus, you cover a lot. You're focused on these mega forces, demographic divergence, digital disruption in AI, geopolitical fragmentation, economic competition, the future of finance, and low carbon transition. Let's start with the digital disruption. Obviously, that's center for everyone. Now, your report is pretty upbeat about all of this. You say the AI investment environment has some core features. Let's talk about those.
Charles, thanks for having me. Yes, indeed. We head into 2026 quite constructive around risk and also specifically quite constructive around AI. We're entering this period, yes, capital intensity is increasing, but the starting point is very healthy for these companies, these large cap companies. And also we're entering this period where there are a huge amount of numbers, large numbers being talked about in terms of CapEx spend. So the outlook, our 2026 outlook titled Pushing Limits, is really focused around making sense of these large numbers. What does it take for these large numbers of CapEx spend to be justified? Right. In our view, there is a way for them to be justified, which is why at this point we're risk on still.
Yeah, it's so interesting because you talk about higher leverage and some of the other things. And you're cheering them on, right? Because you say the cost of capital, the concentrated gains, all those things you see as a positive, while the narrative on Wall Street has been that's the Achilles heel of it. So will this, in your mind, be the most transformational, industrial revolution ever? Will we see this actually surpass the impact of railroads and everything that came before it?
I think if we look at the amount of spend and also especially the speed, the pace of spend, that has already surpassed previous industrial revolutions. And we're also at this juncture where we're not just talking about innovation, we're talking about using innovation to innovate. We're talking about accelerating pace of innovation, which is why actually there is a possibility that for the first time ever in the last 150 years, we could see growth breaking out from the old 2% trend, which is one of the conditions to justify the up to $8 trillion of CapEx spend forecast by the end of 2030. One more thing I would say, Charles, is that we're talking about spending, and that is likely front-loaded. And we're also talking about revenue, but that is likely going to be back-loaded. And as a result of this time gap between spending and revenue, leverage inevitably will have to be created in order to finance the spending, to finance the transformation. But again, here the starting point is very, very important. For these large tech companies, their leverage is nowhere close to what we saw in the 2000s, which is why the comparable between now and then is not really justified. And the whole talk of bubbles is also somewhat misleading because that gives out the sense that we're talking about the market across the board. But this is an environment of winners and losers, winners and losers, and as a result of that, greater dispersion and being active is important.
Yeah, well, and I love, we have the chart you just talked about, the GDP. I mean, you went back a pretty long ways, 150 years, and this actually could move the needle off that, that sort of trend line. And I do love the line where you says it will require innovation and how we innovate, and what you're talking about now. And of course, your firm staying on risk on with overweight U.S. stocks, particularly with the AI theme. But how do we define these winners? Okay, we've got the giant investments, and you just referenced the giant revenues that come in the end of this thing. How do we zero in on the areas that we will be the big winners that will deliver those giant revenues?
So the signpost for us as we navigate the AI trade and also thinking about evolving our AI conviction is to look at a financing gap of some of these large tech companies. Who has the buffer to be able to spend? So that's one thing that we look out for. And of course, we look at free cash flow, revenue of these companies in order to understand if they are still believing in each other and spending on each other. So think about some of the more circular spending in terms of data centers and chips. But at the end of the day, we're talking about spending on each other, but we care maybe even more in terms of the external demand for the products that are being created by all this huge amount of spend, right? So we pay attention to, our end consumers paying for these AI services and what kind of AI services they are paying for, and also are new companies, new businesses, and also non-tech companies actually paying for the tokens, right? So
Right.
for us, in order for this large amount of spend to be justified, new revenues will need to be created, not just existing lines of businesses. And these new revenues, where they are appearing, will be critical for us to identify the new winners. So
Right.
we're talking about AI being applied to non-tech sectors. So think about tech and pharmaceuticals and how the new revenues will be created, but also how it will be split.
Yeah, and we've talked about that for a long time. We already see AI mentioned a lot in these earnings calls, but not necessarily associated with the bottom line. And return on investment has been a big question mark. You've got these large entities out there like OpenAI, Anthropic, and they're laying out a lot of cash. I mean, OpenAI is like at $1.5 trillion, and that raises a lot of question marks. Where do you raise the money? To your point, it's an intensive amount of money, a record-setting amount of money that we've never seen before in the humanity, and the belief, you got to have the belief. And it's interesting to me that it feels like BlackRock, rather, that you have a much stronger conviction about this than most of your competitors.
I would say that we have been very kind of thoughtful and selective in terms of how we want to play this. And yes, we're talking about huge amount of kind of capex forecast,
Right.
which are external credible sources. But as we evolve and think about some of the signposts that I just talked about, as we monitor return on investment of some of this money spent, it's possible that the commitment of capex could be dialed back. We're talking about AI ambitions running up against physical constraints. So think about energy, but also up against financing constraint. Right now, it's not so much of a constraint, but as leverage goes higher, that could start to bind, but also running up against political constraint. Think about AI impact on labor market, for example. So some of these ambitions may have to be curtailed and brought back because of the constraints that could bind in the future. And this is the framework that we use to navigate the AI transformation.
Let's talk a little bit outside of that, because one of the recent worries is private equity. I'm personally still a little concerned here. Private equity, private credit, and one of your tables you show where there have been some large defaults. There's been some bankruptcies. I know it's maybe BlackRock's book, as they say on Wall Street. But how legitimate are the concerns there? Because many people are worried.
Well, what you just talked about, Charles, in terms of default, that is really a K-shaped environment for credit, right? You see some of the defaults are really appearing in the smaller kind of player, the space of smaller players. But this generally, this idea of K-shaped environment that applies to private credit and credit as a whole, but that applies to equities as well, where margins for large cap and small cap really diverging. That applies to consumers, that applies to the economy. I think we're just really in an environment where we have K-shaped everything. So being more disciplined, specifically going back to private credit, those that have the track record, have the due diligence, the discipline, and the lending standard, very rigorous lending standards, will be the one that we focus on. And we continue to think that in this environment where private market will have to step up to bridge some of the financing gap, private credit is still a very, very important role, has a very important role in portfolios.
Less than a minute to go. Just want to look real quickly, sort of sum this up. Your tactical, high conviction there, 6 to 12 months. Still favor AI, selective international exposure, and evolving diversifiers. Less than a minute to go. What do you mean by that, the evolving diversifiers?
Well, we're talking about an environment that is very much shaped by a few concentrated principal drivers, such as AI, right? Like if you, as you read our outlook, Charles, you will see that this is not your typical outlook with forecast for 2026 growth, inflation, and Fed policy. It's really around kind of principal concentrated drivers, and one cannot get away from making a big call on these drivers. So, we look at a mixed portfolio and assets. One cannot be misled into thinking that is diversified because they're all driven by the same things. So investment decisions made under the guise of diversification may well be big calls, which is why let's make those big calls intentionally, not accidentally. And this is what we meant by diversification mirage. So old diversifiers may not be as reliable, and we just really have to have a very dynamic framework to think about diversification, but also be very thoughtful and conscious about the big calls that our portfolios are predicated on, and make those intentionally, not accidentally.
Yeah, I mean, these days it's hard to avoid, like you said, when you think you're diversified, maybe you're not. Wei, we covered a lot. Great report as usual.